Lindsey Piegza is the chief economist at Stifel and joins me from Las Vegas. Good to see you. So, what's happened today? We see the market roar up very quickly after 2 o'clock and then go back down again.
Well, there's a couple things going on. As expected, the Fed opted to leave rates unchanged. And we also saw from the famed dot plot that the Fed doesn't intend to raise rates any additional times in 2019. We also heard from the Fed chairman that the U.S. economy is on relatively sound footing. So initially, this seemed like the perfect combination for the market. The Fed not taking any further action, the economy steady. And what we do know is that historically, Feds have been willing to continue to tighten until the weakness in the data is very clear, thus forcing us into recession. This time, it seemed like the Powell Fed was backing off preemptively, giving the economy still room to run. However, later on, the market started to dig through some of the details of the report from the Fed, as well as additional comments from the Fed chairman during the press conference. And what we saw was additional downside risks, so growing concern within the Fed about the sustainability of the recovery going forward, talking about a reduction of global growth, which of course then could translate into deflationary pressures here in the U.S.
But the Fed has made it clear. I mean, they're using the word patience. This is the new rubric to tell us they're not going to do anything. They've made it clear they're not going to raise rates further this year and probably well into next year. But from your perspective, just how weak is the U.S. economy?
Well, I think right now the economy is still on steady footing. The problem is going forward, a number of underlying indicators suggest waning momentum, and the Fed outlined several of them. We're starting to see business investment lose ground. We're starting to see a slower pace of spending. Remember, we're a consumer-based economy. If the consumer isn't out there happy and healthy, we can't expect to maintain even this 2-ish% growth pace going forward. We also see housing showing signs of weakness. So there's a number of different components that are pointing to downward momentum, or this downward bias that the Fed pointed to, suggesting that, yes, we may see positive growth in 2019, but significantly slower than last year. And the big question mark is, when we turn the page into 2020, are we still able to maintain positive growth, or is this where the recession risk starts to rapidly rise?
Do you believe that a recession is likely?
I do. I think when we turn the calendar into 2020, the risk of recession rises above 50%. We do expect momentum to slow noticeably throughout the remaining 9 months of the year, with growth coming in closer to around 1.5% in the current year. So noticeably weaker than what the Fed is projecting, around 2.1%.
So what is driving this slowdown? I mean, we keep sort of hearing, global slowdown, developing countries, emerging markets, European. Obviously, we know the Eurozone is in some trouble. But what's driving it? Why suddenly, after several years for the US of good growth, is there this concern?
Well, remember, we were already starting to see this downward bias in 2018. Even though the annual growth pace for the U.S. was 3%, we saw the last 9 months losing momentum. So second quarter at 4%, third quarter at 3%, the fourth quarter at 2.5%. So there was this downward trend in activity to begin with as we turned the corner into 2019. But to your point, I think one of the biggest concerns from our standpoint is the consumer. The consumer had very much been reliant on temporary factors for the past several years, including drawing down savings, ramping up credit to above pre-crisis levels, as well as eating into that lingering wealth effect from earlier years of lower cost energy. We hadn't seen meaningful gains in wages. Now, yes, we are starting to see more recently an uptick in earnings, but they're likely to prove very short-lived and are still very isolated throughout pockets of the labor market, as opposed to being broad-based across all sectors. So if you're looking for a catalyst, I think the consumer is a good place to start.